Good afternoon, everyone. Welcome back to another webinar. Today, and this is again during some volatile times that we have been witnessing. We are doing a webinar to address queries, concerns, and basic doubts that people have had, specifically related to how to manage capital in this volatility and how to increase or scale down capital in this volatility. So this is going to be the structure. Basically, we're going to talk about how to use capital in algos, allocation to algos in volatile times, underlying principles of drawdowns in trading, which is basically something that we will require to, look into it. And then we do scale up in algo trading. We will basically discuss about how to scale up, how to do investment into liquid Bs and what are the advantages that you will have with that. Then how we can do scale down and the importance of psychology and why there is still hope in this volatile times. To the context of everyone else and some of the people who might be watching this video via YouTube, because we're going to be uploading it on YouTube as well. Current period, we have gone through a very volatile time, across the last 9-10 months, but specifically in the last couple of weeks. Nothing seems to have been working, and the volatility has been skyrocketing while the premiums are not there. And many systems have faced incredible, drawdowns, and a lot of users have also been questioning themselves. Is it fair to trade at this kind of volatility? So we'll be trying to answer all these questions with basically in setup in terms of what is happening in the current times. What is volatility doing to us? Volatility has increased with increased participation, and the premiums are not going up because there are too many sellers. And this is the basic hypothesis we all have been talking about. So volatility has increased because there are many people who are trading. They are trading many systems, while the market is not giving a direction. And this is probably a phase of let's say consolidation from a bull's bear point of view, from a long-term consolidation point of view. But the fact remains the volatility is high. And contrary to what people feel, that algos prosper in volatile times, not every time. Volatility is not a friend. It doesn't mean large swings. It actually means larger swings than the premiums mathematically allow us. So if the combined premium of Bank Nifty was 600 points, or 700 points yesterday, we had a swing of 800, 900 points. And that's on Friday. On Thursday, when the combined premiums are 200 points, 300 points, still had that kind of a swing. And that is basically what, is defined by this volatility. More volatility is actually giving more chances of SL being hit in the market, and then subsequent reversals, which causes even more frustration. Increasing volatility is a regime change. This is not something which is temporary at all. We were all hoping it is temporary, but it is not. It has been happening for long enough for us to understand that there is a regime change. They are tough for algos because past data doesn't help in it, as past data is from an old regime. The new regime will make new data points, and we are part of that new regime right now. As I said, volatility is also due to other factors apart from more participation. There's a long-term consolidation that is happening in the market. If you talk about global economy as well, there is an uncertainty of a different kind altogether right now, which hasn't been there in the past because there's not been so much of a capital injection and so fast of a capital reduction in the past. So there is a lot of things that are happening at that end. What we talk about as the underlying principles of drawdown in algo trading. Drawdown is essentially, series of lost streaks. And in any drawdown, what will happen is the system will be SL hunted. Signals might be taken too early or too late because essentially market behavior is not in sync with the algos. That is basically what the drawdown is signifying. The market is trying to behave in a way which algo has not designed, or algo has not been able to follow. Our win rate in that case is way much below the historical average, and our DD is generally, when we talk about that, DD ideally comes after, equity high. It's basically nothing but a law of average. When you have had a very good time, then the law of average kicks in, and then it starts making sure it is accepting the universal average returns that are there. So it is inevitable. And some of you might ask, I just started the last 6 months, and DD has hit me hard. But you need to understand the market had been giving fantastic returns for the last 2-3 years, and that is the reason why you got motivated to trade. And now you are trading because of those 2-3 years historical returns, and you have set your expectations accordingly and not getting those kind of returns. So it is very important to understand the principles and then take corrective actions and corrective measures in that case. While we run algos at equity high, basically it is when the system is in complete sync with market behavior. You will not have a false entry, you will not have a false exit. Every time you will be ending up in a winning position, or most of the times in a winning position. Your win rate is above the historical average. I'll actually share some examples on that as well. The law of average has not yet kicked in. And that is the reason why you are seeing this kind of a spectacular return, and you're blown away by the performance of a system, because the law of average has not kicked in for that system. While we talk about all these things, eventually these principles that we talked about, understanding them and adopting them are very important for managing a capital scale up or a scale down, to prepare against a blow up of accounts, because people end up blowing when they have too much risk, they take too much risk, or they underestimate the risk. And both of the things are possible even while scaling up and scaling down as well. So that's something which is very, very important. When you talk about scale up, and that's been the basic reason why people wanted to have this webinar, is a lot of people have an issue with the scale up, because most of you would have started with low capital or multiplier strategies. And in scaling up, most of the times you will do it once the performance is very, very good. And when you say that performance is very, very good, that basically means a strategy is at equity high. And when we are away from at an equity high, and it basically will give you the confidence to scale up on the strategy, but that might not be the right way. We'll talk about those kind of things as well. At peak drawdown, it is also difficult to scale up, because that's going contra, because the strategy is not performing. Someone says, I will scale up. It doesn't inspire confidence across many people. And then not many people can do it. So if equity high is not where you scale, or very good results is not where you scale, very bad results is not where you scale, so where do you scale? Some of the things that we will talk about are a statistical approach on this. Most importantly, when you do a scaling up or a scaling down, you should have a view on the correlation of your strategies that you are using during the scale up or scale down. They can't be highly correlated, because the moment you do scale up with a highly correlated strategy, your P&L swings will become even more wild, and they will start giving you even more headache. So what is this statistical approach that I was talking about? Is that we have to check the win rates. So a rolling win rate, of the algo, how many times in the last 21 days it has made a profit. That is one statistical win rate that we can look into. How much has been recovery from peak DD? That's also very important. So, the idea is not to invest, when the strategy is making a new DD. You have to see when the strategy starts recovering. And when we do this, scaling up, we don't want to take any extra risk, or, make a new formula of scaling up and saying that directionals are working. So we'll do scale up in directionals. Non-directionals are not working. I will not do, scale up in non-directionals. Your psychology is very, very important. That has to be done even before deploying algos, and we have covered it many times, and there are other webinars that you can look into it. And the basic principle here is that we have to stick to our psychology. So basically, how do we scale? If a strategy is in DD but has recovered from peak DD with higher than average win rates, so 21-day rolling win rate versus a historical win rate, if that is showing that there is an improvement, then you can choose the strategy and scale it up in that kind of a strategy with your risk management and psychology maintained. Or if a strategy is near equity high, but the win rate is near about the historical win rate, so the win rate has not gone beyond, so then at that time it makes sense to also increase, because if the win rates are not obnoxious, getting into 90% or so, then the chances of you falling hard is not there. I'll just try and show you some of the things that we are measuring for ourselves as well in our Google Sheets. If you just allow me 1 second, I will just make a switch to that. So when we talk about this historical win rate and last 21-day win rate, I'll try and zoom it up a bit. Right. So we have basically been tracking our strategies here, and most of you are aware of this sheet, and you have seen this sheet many times. I'll just hide this so that we can concentrate on some of the important data, right? And right. So the important data here is win rates. So we have a historical win rate, which is basically of all the time that strategy has traded. And then we have got a last 21-day win rate. Now, the first rule that I talked about is when a strategy is in DD, most strategies that you see here are in DD because the market has been tough. So this strategy is in DD, but the historical win rate suggests that, it used to have a 60% positive rate. Now it has a 62% positive rate. So then it makes sense for us to increase capital in this strategy. Similarly, you go to Zapro. Historical win rate is 49, while it is still in DD, and there is a 52% win rate, which is higher than the historical. So the first part that I talked about, what we are looking at is statistically, are we winning more than normal? And have we recovered from peak DD, which is the case with both of these strategies. If you see their data, you will see they have recovered from peak DD. Maybe we will also try and implement something which will show. So this is DD from peak, but what is the recovery from the peak DD as well? We'll try and see if we can add that part. The other is looking into something like. The other part is if the strategy is at equity high, just like GFD is. So if this is at equity high, so there's zero drawdown. Now the win rate has to be similar to the historical win rate. So which is there. So now this is a strategy that you can scale up as well. This is a guiding principle. So this is not, someone might say, okay, I'll still scale up because I believe in the strategy. So personally, I have also scaled up in GMP and Zap I did before. I scaled up a bit because I personally believed in the strategies and they performed and they gave me the results, right? And that's how we look into it. Again, another example is Zip Bank Nifty, which is actually running at a higher win rate, and then again something that can be scaled up. The other part to also look into is generally you'll rarely find a combo having a difference in win rates as much. So combo data can be a bit misleading on that, but at the same time it also misleading in the sense that win rate doesn't necessarily higher win rate doesn't necessarily mean that it will be at a peak equity high, but it will just be that it has performed significantly better in the last few days in terms of when it's trying to recover. So that's where you have to understand. And generally, what will happen with most of the combos is that the difference will not be huge. Like this strategy TDB, you see, the win rate has gone significantly low as compared to the historical win rate. So this is not a strategy that we are basically recommending to people right now, and we have basically put it out in the private strategies. But such situation in a combo will be very rare, and this is something that will happen from time to time. I'll go back to the presentation. We can refer back to the sheet once again if anyone needs it. So as I said, the capital that we talk about, the scaling of capital, there are two methods. And we discussed both these methods, and I showed you examples of those methods. The other thing is that when we scale up, now ideally when you're scaling up, you're putting in additional capital, or you're scaling up from your the accrued wins. And it's very important to also see scale up in cash versus pledged securities. So when you have a M2M gain, or you have additional capital that you're putting in, most of the times it will be cash. Very few people have pledged holdings in this. So it's important to see this graphic, which basically gives you an idea of what to do when you're scaling up. When you have pledged securities, they are pledged with CDSL, so there's a safety angle to it as well. You get a margin against those trading. And the pledge margin will, give you returns in the systematic trading. Underlying will have their own return. So it is important from a safety point of view, locking your profits and growing your capital. This is the graphic that is being shared by one of our users, Rahul. He has been doing this analysis for quite some time. What this basically means is that if liquid Bs are giving a return of 3% and there is a haircut of 10%, this will change from broker to broker. And if the option selling yearly ROI is 20%, so this is the return that we are getting. So it is better to pledge or not, right? When the liquid B return goes down, then again, this calculation will be in much more, if the returns are lower, then this will, give a better return. So we are talking about annual returns here, gross returns or on an annual basis, or net returns on an annual basis. Let's put it that way. Similarly, when we talk about Nifty Bs, so if Nifty Bs is giving a CAGR of 12% over the last 4, 5, 6 years, and there's a haircut of 8.64%, then what is the thing? So basically, if you're having Nifty Bs, or if you want to scale up in Nifty Bs, it's always better to pledge because it's giving you a higher return. Effective return is higher as you scale up, as you add more capital to it. This graphic, again is an assumption. You can look into this graphic with a view. Like last year, the Nifty Bs might not have given a yearly return of 12%. It was probably 4.5%. But over a period of time, Nifty Bs has given 15% CAGR in the last 10 years, and that's what you can look into and assume. It is also a hedge towards your Nifty Bs investment, because generally, when the market goes down, the VIX goes up. Unlike the situation right now, but that's what happens, and the option selling returns start increasing. So this is another aspect towards scaling up of algo trading, which we wanted to share. Then we have scaling down. Although this is something that is highly not recommended to people, but it may be inevitable for people. Let's talk about it, because not every creator will talk to you about it. This is a reality. If your psychology is not allowing you to trade, if your mental peace is not there when you're trading with such a big capital, when you're seeing so much volatility, so much overnight swings, it is essentially important to scale down. There are a few methods. One is that you withdraw your gains, keep the capital same like initial capital. So if you started with 10 lakhs, you have gained 2 lakh rupees on it, and you want to stop your scale down algo trading right now because you're seeing some volatility. You scale down that 2 lakh rupees and say, I will revert to my original allocation that I was at. When you are scaling down as well, we request you to keep the same allocation, because I end up what people end up doing is that okay, now they start making assumptions that the market is directional right now, and I will scale down, I will stop the non-directional trading, and I'll do only directional. And then there's a reversal, and then there's volatility, like yesterday, like the day before, and then even directional systems will fail. So that's something that we should avoid, to change the allocation at that time. So if you are scaling down from, let's say, 50 lakhs to 30 lakhs, you scale down in an equal proportion. At peak drawdown, scale down is very, very tempting. Everyone wants to feel that, let me save my capital, let me preserve my capital. But if it has to be done, it is to be done with allocation, which is of prime importance. And essentially, psychology has to be viewed along with that. What is your psychological state of trading? Is it an impulse that you're getting? Is it something that you want to talk about? So we'll talk about some of those things in further slides, that what can you do in that kind of a case. But it is very tempting at that time. And maybe in the last week, if you talk about, everyone has suffered, and a lot of people have scaled down their algo trading things, and that's why a lot of people ask me as well, how do we scale down? So that's where we have to look into. So there are some suggestions on it. Why suggestions and not recommendations is because scaling down is very personal to people. If you're not able to sleep at night, you should scale down definitely. You should not look into any of these things that we are suggesting. But it is very important to look into it pragmatically. So scale down should be from a week start or a month start. So we should not do it with middle of the expiry, middle of the weekly or a monthly expiry. As again, I've talked about about allocation and keeping the same type of strategy. So if you have to change the strategy as well, non-directional should replace a non-directional, semi-directional should replace a semi-directional. The whole idea remains that your allocation is proper. So in this slide, or even in the before slide, I have been talking about allocation a lot. Some of you who have not seen our webinars on capital allocation can refer to the webinars. We'll be sharing the links, along with the end of this video, as well as we'll be sharing the links separately to the Telegram group. Last but not the least, if you have to scale down because of an event, because of a timeline, because you are not available, because you are not traveling, any of these things, or if it is permanent as well, you have to plan ahead. If you say that I can't handle the volatility right now with algos, I was trading with 100% of my capital, which is 50 lakhs. I want to withdraw, 20 lakhs, and I will only trade with 30 lakhs on algos. That should be like a plan. It should not be an impulse. You plan it and then don't change that plan for some time, right? You can have goals around it, or you can have, psychological goals around it. Let's say professional goals around it, financial goals around it, but you can, go with a plan. You can't just scale down today and then tomorrow get an impulse again to scale up. And that's where psychology plays a very important role. That's what we come to. So in this volatility, psychology is very, very important. Trader psychology, probably beats everything else in this period, because the volatility does not only impact the P&L, has a permanent impact on trader psychology. I mean, a lot of people you would have seen on Twitter, a lot of people have stopped trading algorithms. They have said, we are not trading our XYZ system. We are not trading algos at all. We are not doing this kind of a trade. We are not doing that kind of a trade. Some people are reverting to manual. Some people are saying we'll stop buying. Some people are saying we'll stop selling. Some people are saying we will do swing trading. This is a permanent impact on psychology. It basically, so if you have progressed towards stability in terms of, accepting a system, that change, volatility change, or the change that impacts on volatility in the P&L and volatility overall will impact your psychology for a longer term or a permanent term. Many algo users have become latecomers to the system trading, and they are fearing like, so they were doing manual trading, they were not successful with that. There was a psychology issue, and they feel that now if algos are not working, we will again change because algo is exposed to everyone. Algo is just like another system. So algo is not going to help you with psychology. Psychology is separate. Algo will aid you to do systematic trading. Psychology is definitely something that you have to work on individually. Algo aids because algo will show you that we are, as creators, we are also trading the same system. We have been trading it for longer, how much results we have got, how it has recovered from DD, and those kind of things will be visible to you. And during a losing streak, whatever we say, 90% of what I've said will still not console a lot of users. They will end up missing some of the biggest winning days. One winning day in a buying algo or in a directional algo can take care of drawdown completely. This is what we saw with Zapro last week. There was one winning week which took it out from drawdown completely. We have to also accept that volatility is here to stay, and we have to scale up accordingly. So if this volatility is really affecting you and making you lose your sleep, you have to scale up or scale down rather than that things. But if you are a believer like I am, that this is not a permanent thing. There is a regime change that is going on. We will just learn from it. We'll improve, and we will be ready for the next bigger leg. Because if you talk about, when you talk about these people, that there were 2-3 years of fantastic returns in systematic trading, and people moved to systematic trading just because they saw this fantastic return, and now they are not getting those fantastic returns. So this is a drawdown essentially for systematic trading. That is what is happening. So I'm believing that in this drawdown, and I'm seeing some signs that we should be looking at, that some of the newer regime change. If you talk about some of the newer innovations that we are doing into strategies, they are giving balance, not completely replacing, but they are giving balance to the strategies that we have been using currently or for a longer period of time. Sorry. So that is giving me the confidence. At Strategy One, we are here to help you with the psychology and training on psychology. We have psychology webinars. There are a couple of them that you can do. You can also book a one-to-one discussions with us on our website. We have a Strategy One community, which is a very active and a very mature community, which will help you out with any psychology issues that you have got, or any understanding that how to scale up or scale down, or how to react into this kind of a situation. They will help you out with it. Last but not the least, there is a hope. We are in this volatility where, as I said, most of the algo trading systems are facing drawdown. Systematic trading in that sense is facing drawdown, while everyone is feeling that there's no future for it, and a lot of people are feeling that systematic trading will not work anymore. It's discretionary trading that will work again. It's again a system. So if people move to algorithmic trading because discretionary trading was getting very difficult, finding bottoms was getting difficult in the market, so people were just using algorithms to make sure that they're trailing properly. So we have to understand that this is a period of emotional, financial, and sentimental drawdown for a lot of users. So we have to accept it. Drawdown, there's nothing that you can do unless accept it and modify your capital or scale down or scale up as per your psychology, what it allows you. Because eventually what we are doing is for creating long-term wealth, creating something for our families. And if you are not having that confidence in it, you are shaky, you've made attempts to build up your psychology, and then still has not worked. So scale up or scale down is inevitable. scale down, I would rather say. It's inevitable, but you have to do it in a systematic way. This is the 11th month of consolidation, probably one of the largest periods of consolidation in history of stock markets. And we have to also understand that. And that's what's causing additional pain. We are also on the wrong side of law of averages. So, when we talk about 2020, 2021, even 2022, for that matter, the first half of 2022, the returns were fantastic for a lot of strategies, for a lot of systematic trading. And now there is a drawdown. We are on the wrong side of the law of averages. It's starting to kick in. It's reducing the overall ROIs, which were, so if you are expecting a 30-35% ROI in option selling in the 2020 or 2021, that 30% was 70%, 80%, 90%. And now, that there will be a drawdown in that sense. And how to handle it, one of the things that I've been always talking about, controlling your cost, which is, although not a aspect of discussion here, controlling your cost is very, very important, which can be done via brokerages and lower brokerages or zero brokerages. That's what we need to look into. What also is important is that we are changing with the regime. We should not miss a participation and again become a late entrant. So if you leave right now, you will become a late entrant again, because for you to get that confidence, you will want the market to show that kind of recovery, show that consistency, and then you will start coming in again. And then again, it might be a late entrant thing that will happen. This is not only with systematic trading, it can happen with algorithms as well. It can happen with many other things in life. So I hope, you guys would get some value from here. This basically concludes my presentation. I've tried to keep it very short, and we can take questions right now. If you have any questions, you can raise your hands, and then I'll unmute you and you can ask the questions. Some of the people who are already unmuted, they can ask the questions and we can answer the questions. I don't see any hands being raised. So is this clear to a lot of people?
Hi, this is Yogi.
Hi, Yogi.
One question here. Hi. Just wanted to check, though you also spoke about drawdown, so we totally understand then. Can you hear me? Hello?
Just 1 second. Hello?
Am I audible? Hello?
Yes, Yogi.
Am I audible?
Yes, Yogi, you are audible.
Okay, so my question is basically, I understand this drawdown which you spoke about. Just one question which lately we have been facing is which is the errors on TT, due to which when we see the data, it might not be captured, saying is that this was the TT error and that day it was because of some broker. Is there a way to basically streamline a process where you can take care of these errors in a better way, which is basically having a tie-up with the broker where there is API integration is better, or you have your own platform of replacing the TT to be able to execute it better?
So, Yogi, I'll answer your question in 2 parts. One is on the data. So, our data that we share has been always data that is a live data which we have got with all the errors that have been there. So, our data does not discriminate between an error day or a normal day. Additionally, coming back to your point on what can be done for errors and what can be done on the frustration due to errors in this volatile times, which can increase drawdowns further. True, there has to be an option that we need to look into. So we are trying to, we have our platform that is under testing and that is there. And then, we will be looking into that. But at the same time, errors can occur all the time in anything. What we are trying to do is be vigilant and inform our users, our managed clients, we are managing it for them, and try and minimize the impact of any error that could be there because of TT or a broker. The other way of going about it is diversifying your capital across brokers and across platforms. So platforms we are still not haven't launched our own, but it is very soon going to be launched, and that will be giving some sort of diversification on the platform. Broker diversification I've talked about many times, and if you need any help in terms of brokers, free brokers that are working well, or brokers which have got very low or order fees like 2 or 3 rupees or so, we can share the information on those brokers. That will be done on the community. Any other questions?
Hi, I have a
Hi,
question.
Gaurav.
In recent times, you have also seen that slippages are like frequently happening. Every day, slippages are happening. So, is there any way to tackle basically many times I see that shared code and my strategy doesn't match many times in the nowadays only. So because of these slippages, like sometimes it happens that in shared code it is seen that it is in profit, but in my case it is in less profit or it is in losses. So
And it has also happened the other way around as well. Share code is in loss,
yes,
and you might have a
yes,
profit.
yes.
So a lot of slippages are also a factor of volatility. And unfortunately, this is what we're talking about. This volatility is here to stay. So how do we solve it is probably getting a better execution platform and those kind of things which we are working out with our own platform that we intend to launch very soon. But still there will be slippages. Slippages are unavoidable. So where do slippages arrive from? It basically arises from basically the bid-ask spread. If you see across strategies or across instruments, you will see there is a difference in the bid-ask, and that bid-ask spread is what is driving the slippages. And then there is a delay, and this bid-ask spread starts increasing. You have calculated it in a particular price, and the there's a volatility, and that has moved the prices in a different direction, and then you start having these slippages. Unavoidable. Yeah, Mayank, I'll allow you to speak. Mayank, you can unmute yourself and ask the question.
Yeah, can you hear me?
I can hear you clearly, Mayank.
Okay, Vishal. Vishal, as you said that there has been a regime change and, we are moving into a period where there is a lot of volatility and the premiums are not supporting it, right?
Yeah.
So what exactly is in your mind, as in from strategy one's point of view, what kind of changes are you looking to make in the algos that they become accustomed to making money in this regime change?
Okay. Very important question, and I think this is something which we have been keeping it to ourselves in terms of what are the changes that we are doing, because we also don't want to get into a situation that we are doing the changes just for the sake of changes, or just because some system is showing drawdown and trying to fix a problem that is not there, because drawdown is not a problem. Problem is not drawdown. Problem is when you do changes during drawdown. Drawdown is a natural process. It's like aging. When you age, you will have wrinkles. That's the thing with drawdown. Drawdown will happen. So there are a couple of things that we are doing. So if you see, I'll give an example. One of the strategies is Zap Pro, which used to be an aggressive strategy, but it has lost the aggressiveness in the low VIX volatility regime. And it started becoming more of a wait and trade strategy, which we did not want the strategy to do. And it was also not coming out of a drawdown. So we had been testing quite a few things on that, that how the same indicator set we can use and increase the effectiveness by making sure that it is remaining more in trade. and it is retaining its aggressive nature. So ZAP was not able to recover from its drawdown because the aggressive nature was not being replicated in the current market. So that we have changed to make it aggressive, and it would have a wilder swing like before as a strategy, but still will end up giving more returns. So yesterday it had a swing from -2% to -9%, ended up at -3%. That's the kind of swing it had, and it stayed in the trade most of the time. And that's what we are doing. Essentially, in volatility, you need a combination of systems which will be sensitive to the changes, as well as some systems which will avoid being in trade all the time. So we have always had those kind of systems. So as you know, ZIP is a strategy which is not always in trade. GMB is a strategy which is not always in trade. Our semi-directionals are not always in trade. The strategies which are always in trade are something like TMS, which again we have made not always in trade. TDS as a strategy which has been doing very well for us, although in the last a week or so has faced 5-7% drawdown. That strategy was a wait and trade strategy on a paired side, but current regime change means the indicators which were showing it to wait and trade, they are no longer making it smart enough to wait at this time. So that's where a change is required, or changing that system from a multi-counter to a single counter is required. So that's what we are working on. Primarily, we don't try and do major changes unless, so if there's a major change, it's a new strategy. If there is a small incremental change, which will have a fix in terms of retaining the nature of the strategy, that we will implement. And that's what we have done with ZAP Pro. We did a small change in ZIP Nifty as well. We did a small, that was about 2 weeks back. ZIP Bank Nifty, we have not changed at all because ZIP Bank Nifty has been doing fantastically well. So no need to do any change in that. And something that we are looking into TDS as well right now. How do we make it a single counter so we can limit the losses, and maybe add another filter in terms of making it not always in trade.
Mm-hmm.
I hope that answered, Mayank. If you have any further questions.
Yeah, most of it. Another thing is, like, I see this time to be the toughest for non-Ds and semi-Ds.
Yeah.
So do you think, like, because there is a lot of intraday volatility, not necessarily like most of the days what happens is wherever it opens or, it comes back to that place almost by the end of the day, but there's a lot of intraday volatility. Do you think like moving the SLs or something like that in non-Ds or semi-Ds would help, or nothing needs to be done?
So when you talk about P&L based SLs, those can be visualized from a premium point of view. What is the premium that we have got, and this is that we can do. The moment we change indicators, you are actually changing the entire nature of the strategy. So then it's better to phase out a strategy and then put up a new strategy. So for example, TDB, right? So TDB, most of the drawdown has come in from the expiry scalping thing. So that's why we have basically archived it, or basically put it into private, because it's under DD, and that scalping is not been working for expiry. So that's what we have done. At the same time, there is another scalping algorithm that we have been working on. It's doing fantastically well. Yesterday it gave, you would not believe, one of the users got 10%. I got 6.5%. One of the users got 10% in that scalping algo. So we are testing some of those things. It is risky as well. One of the days it is given -5%, another day it is given +7%. This will keep happening because the volatility is such that the more you trade, the more you can get caught as well. So
right,
you have to have a mix of approach towards it. Essentially, changing a lot of things in the system basically ruins the system completely. P&L changes, trailing changes are smaller changes in that sense. System change, or basically change in the indicators which are giving trailing indication or switching indication to a different strike or moving to a different strike, that is a major change, and that might not work. I hope
Hello?
that answered. Yeah, Mike.
Yeah. Okay. Thank you so much. That answers most of it. Thank you.
You're welcome. Anyone else has got any questions? If you are muted, you can unmute yourself. If you can't unmute yourself, you can raise your hand. I'll unmute and you can ask me the questions. No questions? Okay. Leo. So I've asked, so Leo, I've unmuted you. You can speak. And Mr. Indadul, just give me a few minutes. I'll also allow you to speak. So Leo, you can ask your question first, and then Mr. Indadul can ask his question.
Hi, Vishal. Can you hear me?
Yes, I can hear you.
So what my question is that like basically we are an option traders, right? So like VIX is the like heart and soul of options trading. So whatever the changes you have made, it may work in the low VIX, let's say 15 and below, but it may not work in VIX like when you are on 20. Okay. So can we have like different set of strategies that this one is useful for 15 and below, or this one is more productive or like better risk reward for when the VIX is like 20? Is it possible?
So I think that's what, a lot of people have been trying to say, that this is a strategy that will work in low VIX, this is a strategy that will work in higher VIX. The first slide itself, I think you have missed it.
Yes,
the current volatility is not measured with the current VIX. Our VIX is showing much lower volatility, while the intraday volatility is much higher.
Right.
VIX, let's understand how VIX is calculated. VIX is calculated from the premiums of forward options. If those premiums are low, VIX is low.
Right.
The volatility in the market is basically very different from the VIX that we see. Yesterday there was a swing of 1,000 points, and the premium on Bank Nifty straddle is 600 points. So what does the straddle premium, or 700 points? What does the straddle premium indicate? It basically indicates, yeah, exactly. It's a range in which the market should operate. Now Thursday, we again moved 1,000 points, 800 points in Bank Nifty. Right? If you see the swing, up and down swing. But the premium was 200 points, 300 points. Yeah. So VIX is not a factor. However, we can use VIX in a certain way. VIX increase has an impact. It doesn't matter how much the VIX is, but VIX increase has an impact. And can we use that in our strategies? That is what we have been looking into, and then trying to say that, okay, how can we use it? But can you just define the current low VIX regime as actually low VIX or low volatility? No, actually this low VIX regime is very different from previous low VIX regime where the volatility was less. Today the volatility is much higher. So the regime change is higher volatility with lower premiums. And that's what we have to solve.
It's like, for example.
Yeah.
When you look TMS, it has, given exceptional ROI in, I think, May 22 last year. But since then, it is not like struggling for the last 3 or 4, just running flat, absolutely. So, what was the VIX then in May, and it has, outperformed and given written like a directional strategy. So that is exceptional for non-directional, like 9%. But then it's like TMS is like, completely struggling, just running flat month over month.
True. So there is another part to it, right? If you say that it was because the VIX was high, Let's see how high the VIX was. Can you just go and check what was the VIX at that time, May 22?
Right.
What was the average swing at that time in the index? The average swing in the index was much, much less. Right now, the average swing is much, much higher. So what is happening is, as a strategy, it has a stop loss on the straddle. That stop loss on the straddle is hitting, and then it is coming back to the same point. This is what happened on Thursday. We moved so many points, but added and came back to the same points. Now, can we put that, as a percentage of, let's say, straddle premium? No, we can't, because the volatility and the straddle premiums are not matching.
Right.
So it's a regime change. It basically means that in TMS, we'll have to do something else. And that's what we have done in the last few days. We started making it much, much more, wait and trade. I would not want to, in this kind of an environment, if it is given flat returns, while most of the times, if you talk about paired strategies, they have gone into losses. I would consider that as a decent performance, but we will keep on looking into what we can do in terms of improving the strategy, given the regime change that is there. I hope that answers your question.
Yeah, thanks.
Yeah. Mr. Indadul, you can unmute yourself and ask a question. Mr. Indadul, you have to unmute yourself and then you can ask your question. Okay. Anyone else who's got a question? Any more questions, guys? So I'm assuming there are no more questions. Mr. Indadul was here, but he's no longer here. He's left a call. So I'll take a question with him personally. Any other issues that you have? As we have said, we have links of our web strategy, the webinars for psychology, capital management, and other things that we will talk about. And you can all, go through those. If you have any questions, we are there to help, be it on one-to-one basis, be it, viewing those webinars or our Strategy One community, which is a very mature community. So I'm sure you will get whatever help that you need from the community itself. Really, thank you guys for joining in on a Saturday. I hope this webinar helped you in getting some information and understanding. Looking forward to interacting with you guys much further. On these kind of things, and have a good day, guys.
Thank you, Vishal.
Thank you.